80% of all breakout attempts fail, yet most traders lose money by chasing them. Today, we master the math of market inertia. The single most important statistical reality in trading is inertia. Markets have a heavy tendency to continue doing what they have been doing, and for the majority of the time, they are going nowhere. We call this trading range behavior, and it accounts for roughly 80% of all price action. A trading range represents a temporary equilibrium where buyers and sellers agree on the price. In this state, the market is efficient, and neither side has enough conviction to move the price to a new value level. Volume is generated by uncertainty and two-sided trading. When we look at a chart, a trading range is defined by horizontal price activity with significant overlap between bars. Unlike a trend, where highs and lows move in one direction, a range oscillates between a resistance zone at the top and a support zone at the bottom. Within this box, the rules of trend trading are inverted. In a trend, we buy high to sell higher. In a range, buying high is suicide because the probability of follow-through is low. We must adopt the mindset of buy low, sell high, scalp. The most dangerous moment for a trader is the breakout attempt. As price approaches the top of the range, momentum often increases, making it look like a strong trend is beginning. This is the trap that catches amateur traders who chase green bars. Let's examine a classic bull trap. Notice how the price accelerates into resistance with a large green bar, perhaps even closing outside the range. The amateur sees strength, but the professional sees an opportunity to sell to trapped bulls. Why does this reversal happen so consistently? Institutional bears scale into short positions as price rises, while institutional bulls take profits at the highs. When the last buyer has bought, the vacuum effect pulls price back down to the middle of the range. The 80% rule states that 80% of breakout attempts from a trading range will fail. This means betting on a breakout is a low probability trade, even if the signal bar looks strong. You are betting against the inertia of the market. The same logic applies to the bottom of the range. Strong bear bars near support often terrify longs into selling, creating a bear trap. Institutions are waiting there with limit orders to buy the low, betting that the support will hold again. Successful range trading requires fading these moves. To fade means to trade against the short-term momentum. You sell when the market looks its strongest at the top, and you buy when it looks its weakest at the bottom. However, we do not simply place limit orders blindly at the edges. We need a signal bar to confirm the reversal. We look for a rejection wick or a strong close back inside the range to confirm the breakout has failed. When we identify a trading range, our profit target should be conservative. Since the market lacks direction, we cannot aim for home runs. We aim for the middle of the range or the opposite side, scalping profits quickly before the market reverses again. A specific type of dangerous price action is the tight trading range or barbed wire. This occurs when bars overlap almost completely, often with dojis. The market is in total indecision, and the probability of a successful trade here drops near 50%. In barbed wire conditions, the best trade is usually no trade. The signal bars are poor, and the potential reward is small compared to the risk of being stopped out by random noise. Patience is your primary edge in this environment. Understanding the legs of a range is also crucial. Markets within a range often move in 2 or 3 legs. If you see a move down from the top, expect a pullback and a second leg down before the move is exhausted. Let's look at the vacuum effect again. Often, right before a reversal, price will accelerate toward the support or resistance level. This isn't strength. It's the market sucking price to the liquidity level to test it before reversing. So, when does a range finally break? The 20% of the time that a breakout succeeds, it is usually accompanied by a measure gap or a very strong breakout bar that closes far beyond the range with little to no wick. If you miss the initial breakout, do not chase it. A successful breakout will often pull back to test the breakout point. This breakout pullback is the safest entry for a new trend, converting previous resistance into support. Here is the logic for switching from range mode to trend mode. We need consecutive strong closes outside the range. Until you see that, assume the breakout will fail and the price will return to the center. Many traders lose money because they anticipate the breakout too early. They see a wedge pattern or a triangle and bet on the break. However, these patterns often evolve into larger trading ranges rather than trending immediately. Let's analyze a complex chart. Here we have a broad channel that is essentially a sloping trading range. The strategy remains the same. Sell above the channel line, buy below it. Do not trade in the middle third. The middle third is the kill zone. Probabilities here are 50/50ths. The smart money enters at the extremes where the risk-reward ratio is skewed in their favor. If you find yourself trading in the middle, you are gambling, not trading. Second entries are powerful in ranges. A second entry occurs when the market tries to reverse, fails, and then tries again. If a reversal setup fails once, but the market holds the level and signals again, the probability of success increases. Remember that context is king. A trading range that forms after a strong bull trend is often just a pause before trend resumption. However, if the range persists for 20 or more bars, the probability of reversal becomes equal to continuation. When trading ranges, stop placement is critical. Your stop must be wide enough to survive the noise and false breakouts. A common technique is to place the stop at a measured move distance based on the height of the signal bar. Let's review the measured move concept inside a range. If the market breaks a minor support level within the range, it often travels a distance equal to the previous leg. This helps in setting profit targets for scalps. To summarize the 80% rule, expect failure. Expect breakouts to reverse. Expect strong bars at the edges to be traps. This psychological shift is difficult because it requires doing the opposite of what feels comfortable. Your checklist for range trading. 1. Identify the boundaries. 2. Wait for price to reach the extreme. 3. Wait for a signal bar, reversal candlestick. 4. Fade the move. 5. Take profits quickly. If the market generates 3 or more consecutive trend bars overlapping less than 50%, the range has likely ended. This is the only time you switch strategies. Until then, the box is your world. Trading ranges are where patience pays the highest dividends. The market is trying to confuse you and shake you out. By understanding the math of inertia, you can stand apart from the crowd. Remember, institutions are doing the same thing. They are buying low and selling high to accumulate positions. When you fade a breakout, you are trading alongside the institutional algorithms that provide liquidity. Master the range, and you master the majority of price action. In the next video, we will discuss how to identify when a range is finally transitioning into a trend and how to catch the big swing. Trade well. Respect inertia until the market proves a new trend exists.